Hi guys, welcome to this month's webinar in regards to how we're going to make 10% returns in a crashing market. Now, what I'm going to do, let me see if I can stop this and I can actually start to share the screen, guys. There we go. Hope everyone's well, first of all. And of course, if you sort of like and want to subscribe to hear about more information that's coming up, we've got a lot of great projects coming up. We've got some podcasts that are coming through. We're probably going to go maybe a bit away from the webinars and start with a lot of podcasts. And what we want from you guys is actually some more real-time questions that you're going to sort of send over to us. So any time that you've got a question that you want answering on our monthly recordings or our monthly podcast, let us know. We are going to send an email out about this. But yeah, if you hit the subscribe button, hit the like button, then we can kind of really help you guys out in real time, rather than doing a webinar which might be slightly out of date by the time you see this. We're going to try and do some actual real-time questions and answer sessions. So look, without further ado, let's jump in. So let's share my screen back again and we can dive in here. So look, first of all, a lot of people are still looking to make the best returns they can. They've spoken to us about, is it still worth jumping into the property market? They've looked at other markets out there. They've looked at the bond market, the stock market. Of course, we've seen the stock market in the UK reach all-time highs. For those people that look in the stock market and think about investing into the American market, well, the issue with that is that the exchange rate in our favor is very low. So we're not getting very many dollars to the pound. So ironically, we could make 10, 20% on a stock, but we could lose 10, 20% on the exchange rate, which means that it's probably not viable to invest in the American market at the moment. And so what they're looking at is that they're still looking at the tried and tested method, which is the property market. The hold up has been for everyone, let's call it as it is all the negative news that's surrounding the market at the moment. So a lot of people are saying, is it still worth investing if the market crashes by 5, 10, 15%? And that's always not classed as a crash, by the way, guys, but that'll be a correction. But if it crashes by any more than that, is there still money to be made? So look, without further ado, let's take a look. So the first thing is that we're going to cover here is the 5% fall, as you can see here. So the market has fallen. There's no getting around it. The market's fallen. It hasn't crashed. There's been a slight correction, but we have to look at it in a few different ways here because there's a lot more going on than meets the eye. So the reason why we put all is not as it appears, because there's different markets. Now, what we basically say to everyone is the reality is that the majority of what you will read in the papers will be from either the Halifax report or the Nationwide report. But again, they're lenders. So they are reporting on the mortgage market. They are reporting on the market, the average sale price known to them in regards to what they've lent on, etc. But however, the market isn't exactly like that. And what we're going to show you here is that there are three different markets. There's actually the cash market, of course, the mortgage market, and the reality is there's a separate market as well. So I'm going to show you those, or there's a combination of those two. But as we all know, the reality is what market's going to go down the most? Well, it's going to be the mortgage market, because if people have got cash, well, the reality is they can probably afford to buy, something, whether it's 10,000 less or 10,000 more. But how does that affect people with mortgages? Well, when mortgages are up where they are to, which is around 4.5% at the moment, they've only just started to come down to that level, by the way. But the reality is people were struggling to get mortgages and struggling to their payments. So they needed to sort of, get that price down by 5-6%. So let's have a look at what else is going on behind the scenes. So you've got here, as I said, there's different markets under the hood. You've got the cash market, you've got the mortgage market, and you can see asking prices. This is actual asking prices based off of your right moves and your Zooplas. The reality is that asking prices have come down about 2.3% from its peak in 2022 to January 2023. They've come down 2.3% from its peak. Now that's different to the mortgage market. If we look at the mortgage market, the fall has actually been nearly 5%, just shy of 5%. So on average, £13,881 from its peak to January. But if we look at the completion market, and actually a lot of these are completing that haven't actually completed yet. So a lot of the mortgage market issues that we've had, it might take 4 or 5 months to complete on a property. So we're not actually seeing those factored into completions. A lot of the completions that took place recently, a lot of them have been done in cash. We're actually only talking about 28% of the property market in general in the UK is mortgage. The rest of it is cash. So you're talking about a healthy amount of cash in that market, which also protects things like downturns, repossessions, etc. But actually it's only 0.4%. So that's actually really key. Now that was actually up to December 2022. But as I say, the reality is that we're going to see more of this come to fruition over the next sort of 2 or 3 months once the mortgage market actually kicks in. But we're actually really confident that because obviously the mortgage rates are coming down, that market should actually be a little bit more stable. But the reality is that if we head back to the mortgage market, we are 5% down on where we were at the peak in 2022. So then, of course, we come to investing now. Do you wait? This is what's on everyone's lips. A lot of people, you know, and make no bones about it, I totally understand. A lot of clients are saying, oh, they might put it on hold, they might wait, and they give a variety of different reasons why they might wait. But the main reason, what it all boils down to is, if I wait, am I going to save money? Am I going to save more money than if I buy now? Then two, am I going to make more money long term? So, for example, if something's 200,000 now, why don't I wait till it comes down to 180,000, buy it then, I've saved £20,000, and of course I've made more money in the long term. Now, on the face of it, it makes total sense. If you've got one product and you can save 10% on that, of course you wait till it comes 10% down. But the property market doesn't work like that. It's not like where they do a January sale and you get, you know, X amount of money off your property. It just doesn't work like that. So let's sort of dive a little bit deeper. Is it an opportunity to invest now, or is it a threat? So, of course, as I mentioned there, if the reality was that we could say, well, by April 2023, that's when you're going to go and get your 10% discount, totally agree, wait, or June, July, whenever it may be. But as I said, the property market doesn't work like that. So what amateur investors do, now, it doesn't matter whether it's the property market or the stock market, is they wait. So, for example, let's take the last great opportunity in the stock market. Let's have a look back. The last great opportunity in the stock market was actually COVID. 2020, March, April time, stock market plummeted by 33%, whatever it was at the time. The majority of people watching this, I can guarantee you didn't invest. Why? Because you thought it was going to plummet and there was negative news everywhere. So you thought, I'll keep my money where it is. I'm not going to buy. But that was the time to buy. If you look back now, that was the time to buy. So the best time to buy was during that downturn, during the negative news. And property is actually no different. There are bargains to be had during the downturn. What you're looking for is a bargain. You're not looking to sort of wait for that discount to kick in, because it doesn't work like that. You're actually waiting for the bargains to be had. So if you approach a developer in an upturn, let's go back, wind back a year, everything's going, you know, swimmingly well, everything's fantastic, and you approach a developer and you turn around to that developer and you say, right, I want 5% off. What do you think the answer is going to be? The reality is the answer is going to be no, I'm selling them. Everyone's buying my apartments. I've got no need to discount my apartment whatsoever. However, during a downturn or a perceived downturn, and where there's more negative news, you get negative news all over the place, the developer is reading the exact same news that you are. So do you think that they're going to be more likely to give a discount now or less? Well, the reality is more likely, because they're reading the negative news. They're thinking the same as you. They're thinking, well, could this go down further? So what they're actually saying is, well, actually, if I, offer a 5% discount now, at least I've got that deal secured. So there are bargains to be had. Now, what I would say to you is you should be bidding down. You should be bidding down anyway. But the reality is you're going to more likely get that discount now than you would have done a year ago. So use this downturn, use the negative news as an opportunity. And if you go and get 5% off now and you save yourself £10,000, whatever it may be on the price of the property, well, actually, that you wouldn't have saved that previously. And we're going to come to later in the webinar the fact that actually is the property price going to keep going down so you could get it cheaper than that. But the reality is that the property market should start to curve out and start to go back up. We're not expecting a 2008 crash, 2009 crash due to liquidity issues. Everything's a lot more secure now than it was then. But use the negative news now as an opportunity. That's the first thing. As I said, developers are more likely to give discounts. You've got to put yourself in their shoes. They want security. When they're developing, where they make their money is on completion. They don't make their money when they buy the land. They don't make their money when you exchange on the property. They make their money on completion. So what they want to do is secure all the contracts now for exchange, knowing that they've got a promise of all this extra money coming, whatever it may be, 70, 80% of their GDV, gross domestic value of their actual property, ready, coming to them on completion. And that's where they make their profit. So if they secure the exchanges now, they're happy. If they don't, they get nervous. And that's what you want to seize on. You want to seize on the fact that their nervousness and to get that opportunity in. And as I say, not only that, if you get something at a discount, you've got rents increasing as well. I mention this development all the time because it's the latest one that we've completed on, but we had 115 units that we sold within 6 to 8 weeks last year. And the reality is that we thought rents would be £800 to £900. They've come in at 1,100, 1,200, far exceeding our expectations, giving clients an extra 30, 40% income coming in. And as I say, clients are now getting 8%, 7.5% to 8% gross income on their project, which is a fantastic amount. So again, in our opinion, it creates an opportunity. That doesn't mean that you just go and buy something face value. That's not an opportunity. The opportunity is when you get a discount. So we should be asking for discounts, and we will go and fight your corner for you. And again, lenders are starting to fight for people's businesses. There's, mortgages were up at 6.5%. Lenders didn't know what was happening. They got scared. They got nervous. They pulled all the mortgages from the market. But now they're realizing actually this is their core business. This is how the banks make the money. So what do they need to do? They need to fight for your business. And that's what we're seeing now on a daily basis. And rates have fallen below that 4% mark. I actually think by the end of the year, we'll be back down to 3.5% in terms of where mortgage rates are. I think we're going to be in a lot better position towards the end of the year. So again, how are you going to take advantage? Well, as I mentioned, the Zoopla report, latest Zoopla report shows that actually the market's still increasing year on year, that is. So year on year, we're still up. And we're still increasing, but we know that the last 3 or 4 months the market has taken a little bit of a tumble, as we covered the first part of this webinar. But the demand has started to increase as well. So the home buyer demand has started to increase back up on level with 2019, and they do expect further growth anticipated for the second quarter and the third quarter of this year. Now that's normal. The second and the third quarters of the year, that's normal to have an increased demand. Why? Because it's spring, it's summer. People are more likely to go and look at properties in the spring and in the summer rather than, dredging themselves out in the winter when it's cold. So if that's going to happen, if we're going to start to see an increase in the spring and the summer, you don't want to be buying in the spring and the summer, because if you do, then, developers are happy. They're getting their money in. You want to be getting in when developers aren't getting their money in. So just to give you an example, our January was a little bit flatter in terms of our sales, but our February, we've had the record amount of sales in February so far from any February, and we're probably going to have our best month ever since the company started. Now, why? Well, because people are getting discounts. They're going in. If something's 200, they're bidding 180. They might get it for 190, but the reality is they're securing these discounts. And the development might be off plan, so they don't have to pay anything now, or they have to pay very little, 10%, for example, and the rest is paid on completion. And again, securing the knowledge that the reality is that the rates should come back down by then, and they're going to hold it for over a decade anyway. So the slight nuances in prices now make very little difference at all. As we mentioned before, developers' weakness, you've got to prey on that, because that's the key to getting your discount. And as I say, we really recommend buying off plan, because a lot of people think, well, if they buy a £200,000 property or a 500 or £1 million property, whatever it is, well, that's what you paid for it. That's actually incorrect. That's not what you paid for it. You haven't paid. If you buy a £1 million property, you have not paid £1 million for it. You've paid whatever the mortgage interest is, and plus the million. So if you paid £1 million for your property, or you bid £1 million, but you've paid £500,000 in interest over a term of whatever, let's say over a term of 20 years, that's actually what you paid for your property. You paid 1.5 million for it. So if we then had a better mortgage rate, which actually meant that you only paid £250,000 interest, then you actually paid 1.25 million for it. So you actually paid less for that property. So what we always say to people is, look, the property price that you buy it for isn't actually the property price that you end up paying. It's the interest that you pay on top. So what we need to make sure is, one, your interest is paid by the renter. That's the first key. Secondly, that your interest is as low as possible. And how do we do it? Well, we wait for the right mortgage rates. It's as simple as that. So what you guys need to do is to say, I'd be buying off plan, and I'd be waiting for at least 8 to 12 months to get that completed, maybe a little bit longer, to wait for rates to come back down to a bit more of a sensible level, which we are already seeing. But that's the key. Again, long-term mortgage rates, we do expect the interest rates actually being factored in to go up to 4.5%, then start to come back down. In my opinion, it might not even get to 4.5% as we start to see inflation come back. The pressure for the Bank of England to keep putting rates up will obviously disperse slightly, and we should start to see that rate fall by the end of the year. And again, it's got to be long-term, guys. If you're planning for short-term growth or short-term income, forget it. The property market is not for you. Maybe a casino is, but certainly not the property market. You've got to look at a 10-year plan. If you're not looking at a 10-year plan, I would forget it, because the key to this is, and have you ever seen a property market fall over 10 years? Now, what I mean by that is if you take a 10-year period, whether it's from 1990 to 2000 or 91 to 2001 or 95 to 2005, or even 2007 to 2017, that would have captured in the peak, a fall, and then back to the peak again, is have you ever seen a decade which has fallen? The answer is no, we haven't. We've never had that full decade where we take 10 years, where we can pinpoint at the start of the 10 years, whatever year you choose, the start of the 10 years where it's fallen, and within 10 years, it hasn't recovered or gone up even further. There hasn't been a decade like it. So as long as you plan for 10 years, you know you're going to have that security and that safety blanket of the fact that the growth is going to increase and going to outdo what you originally paid for the property. So then can you still make money? 100% you can. It needs careful planning. It's not like what we did, 1, 2, 3 years ago. It was easy to make money. Then you could get properties, you'd get it rented out. The only tough time that we've really had in the last decade, to be realistic, is COVID, where people struggled to sort of rent out certain properties on a short-term let, but we switched them over to a long-term let. But how do you do it in a market that's potentially falling? Well, the reality is, like I said, the key is location. The city centre is everything. What you don't want to be doing is buying on the outskirts where fashions and people wanted space. Now they don't need space. You buy city centre, and it doesn't matter what happens in the world economy over the next 50, 60 years. City centres are always going to be the hub of jobs. They're always going to be where people want to live. They're going to be the hub of, socialising, nightlife, going out. So city centres are the key. Now, they're even more in vogue at the moment because people want smaller apartments because they want cheaper energy bills. But again, irrelevant. Your energy bills will eventually come back down. The reality is what you want to do is get what's long-term works. And, if you take over the last 50 years, where would you have bought? Well, these suburbs wouldn't have been around at that time. So you look at London, 50 years, over the last 50 years of property, you'd have made money there. Areas in Manchester, Liverpool, city centres, you'd have made money over the last 50 years. That's where you want to be buying. And you look at the best markets around the world, whether they're Berlin, New York, Madrid, Rome, they're all city centres. And that's where you'd want to be buying 50 years ago. So stick with city centres. Invest in properties that you can do both for long-term and short-term. So you can flip. If long-term is in vogue in the area, which it is in Manchester at the moment, go long-term. The moment that starts to diminish slightly, we can switch to short-term and make fantastic gains there. But at the moment, you want to be going, you have a property that goes between the short and the long-term. That's the key. And like we said, for us, off-plan is definitely the way forward, because the reality is, if you buy off-plan, you've got so many more. First of all, you've got time to save up more money. That's the first thing. And the more cash you have to put down for a deposit in relation to your mortgage, so the lower your loan to value, the better the rate you get as well, because the banks feel a little bit more secure. And as I said, so the low deposits mean you can secure a price now and actually pay the remaining across 18 to 24 months. We've got some developments where you actually only have to put 5% down, and you can pay a monthly retainer of 1,500 or 1,800, build up your deposit over 24 months, and actually then you put 30% down and you go and get your mortgage on the remaining 70. So there's great options to be had as well. And again, tax benefits, you've got to think ahead. So many people make the mistake of just thinking, I'll put it in a personal name and I'll deal with the rest later. You can't deal with the rest later, because if you want to transfer it from your personal name to a company, you might have to pay another lot of stamp duty. So start as you mean to go on. Plan it, first of all. Speak with one of the brokers out there. Speak with the team. Plan all of your decisions, first of all. Even plan for when you're thinking of selling it. Whether you're going to sell it in 7 years, 8 years, 9 years, 10 years, plan that already. If you've got kids who are 7, 8, then think, well, actually, I might want this for their university. So think, I'm going to buy it now and I'm going to sell it when they're 18 to, start to pay for their university, whatever it may be. If you, the best plans laid down now, that's what's going to get you the best rewards over the next decade. And again, ensure your income is higher than the mortgage rate that you're paying. What you don't want to be doing is, having a punt a property, thinking, oh, you know what, I'll be all right signing up to 7%. And then suddenly the income that you're coming in doesn't even cover the mortgage. That's not what you want. So everything is, like I say, meticulously planned at our end. You phone up 10 companies, and I can assure you 1 or 2 of them, us included, will just be like plan, educate, and there's no hard sell. The other 8 will be sending you, emails day one, telling you what to buy, telling you that stuff's running out. Again, that's not the case. Plan first, buy later. That's exactly what we do over here. So again, what are we expecting? Now, this is the key. This is what everyone's asking. Do I wait? If we're getting 10% discounts now or 5% discounts now because developers are worried, if the market keeps falling, can I benefit twice? That means, can I benefit from a falling market and then get another discount on top of that? Potentially, yes. I don't think so, is the reality. Now, why? You can see here, if we look at the left-hand side, so we've got the grey line, which was the 2008 crash. Now, it didn't even come down. So although we were, 18% falls, it took 15 to 16 months to get to that. It wasn't an overnight thing. So, people that would have actually benefited the most would have had to wait 15 months to get that. However, the chances of people buying at the bottom is slim. But if you look at the red line, you can see it's starting to even out already. Now, I think what's going to happen is I think we'll probably get down to maybe 8%, 7 or 8% dip initially by the end of April until we start to see that curve come back up again. And I think by the end of the year, we might even be 1 to 2% up on where we were. So I think the reality is that the time is now. Once developers feel a little bit more comfortable, once mortgage rates come back down, you will not be getting the bargains that you're getting now. So I would be taking advantage of these 100% all day long. I certainly don't think we've got, more than 3% to go in a little correction. And I certainly don't think there's going to be a crash. And why? Well, because we don't have liquidity problems that we had in 2008. Mortgage rates are coming back. Mortgage rates, ironically, were higher in 2008 than what they are now. And again, everything's in our favor in regards to there's not many other places to put your money. The stock market's high, dollar rate's not great, so people aren't putting their money in the US. So actually people are either leaving it in their bank, which is being eroded by inflation, or they're putting it in the property market. And of course, the reality is, as I say, you've got to aim for that long term. If you aim for that long term, you're not going to have any issues whatsoever. So guys, this is kind of over to you. I'm going to hand over to you. We can answer any sort of questions that you might have. There should be a couple of things. There should be a chat box, or you've got maybe a question mark on your screen. I don't know how it looks on your screen, so I do apologize. But yeah, let's have a little look at the questions so far. What's my prediction about the exchange rate given the shift in how much money the US is printing? Yeah, I agreed. So again, don't quote me on this, but I read something along the lines of 40% of the money that's in circulation. So 40% of the wealth created in the US at the moment has actually been created within the last 2 years, 2.5 years, pretty much. So since they started printing money because of COVID, or partly because of COVID, the reality is 40% of that wealth has been created. Now, that is not sustainable. That's got, frightening inflation written all over it. I don't think we've seen the worst of it yet. But what I do think that's going to happen, I think that what we'll see is the exchange rate in the US get weaker. So what I mean by that, so if people are buying in the US now, if people have got their money in sterling and they're buying in the US now, whatever it may be, I think actually you'll probably be losing money because the exchange rate roughly is 120 now, for example. If it goes up to, if you've got your money then in the US and it's at 150, well, the reality is that you've lost 20% odd. So I think that it's a real big advantage for people in the US now, or who have got dollars, wherever they are, who have got dollars, to be buying into sterling when the currency is a little bit weaker. Don't get me wrong, it's not as weak as it once was when we saw it at 106, 107 and those kind of marks, but we're still pretty low in the whole scheme of things. And I think that people that got their money in the US at the moment have a real big advantage. You could invest in sterling, as in a property in sterling. You could probably make 20% over the next 5 to 7 years just on the exchange rate. You've probably got maybe potentially 20% and beyond over the next sort of 5, 6 years in growth. Plus, if we're making 5, 6% every single year in terms of your income as well, then you've got like 70% over the period of sort of 5 to 7 years, give or take. That's a really strong return, circa 10% a year. But the key is, as I say, strike while the iron's hot, get the discount in the property, but also get that dollar into sterling. And I think there's some great gains to be had. What do you see within Liverpool City Council for approving building plans? Is it a slow process or have they caught up? Okay, so what I've seen is that the Liverpool City Council has, or the council's been taken over independently. The planning is well behind. They're slow. I see it getting a little bit quicker, but it's still not to where it's still not where it needs to be. There are certain plans in there that have been in there for months on end without even being looked at, let alone being declined or accepted. So I do see it getting better, but they're still not up to the speed of other councils, whether that be the London, the Manchesters, even local councils in Essex near me. They're far more efficient than Liverpool City Council. They had a huge backlog. And what they did have to do is there was a lot of corruption within the Liverpool. I mean, it's crazy that we're saying it in a first world country that you've got corruption within the council, but I'm sure it's not the only council. And the reality is that they had major issues, so they had to all get replaced, and they've caught up on a lot of that work, but there's still a way to go. Is there an update video on Liverpool Waters construction? Do you know what? It's something we've asked about last week. We've sent Jeff is the no, it's not. It's Greg. Sorry, I always say Jeff. Greg is the developer. So we've sent him an email last week to ask for the latest in terms of video up there, what's happening, and he should be sending it over. We're really confident with this developer up in Liverpool. We've always been, especially lately because of issues with Liverpool, we've been a little bit concerned with certain developers. But we've got no qualms about this this guy and his team. They're really good. They've already built a couple up there on time, on point. So yeah, no problems at all. But we will send it out as soon as we've got it. As the conflict in the Ukraine continues, how do you see it affecting the UK global housing need and then the housing within the UK? Well, look, let's be realistic. If we have a lot of people coming over from the Ukraine or from countries which are war-torn, then we're going to need more housing. So that puts more pressure on housing. Can I answer that directly as in, how it will pan out? No, I don't. But the reality is the more and more people who get out of Russia because they don't want to be under certain rule, the more people who get out of Ukraine. And all I can say is what I'm seeing on a daily basis. We put a job advert out for a digital marketing manager only 2 weeks ago. And I've had more people coming from Russia and Ukraine than we've ever had apply. So again, it might just be something that this particular job, but it seems like that there's more people coming from those countries into the UK. But again, that's going to put more pressure on the UK housing market. They're going to have to rent, obviously. The UK isn't building enough. So again, long term, it's only going to push prices in one direction. Does completion risk increase in a recession? Depends on how you mean that question. So does it, so yes, so completion risk, if people are buying with mortgages, there was a big completion risk back in September, October last year. When the budget came out, all developments that completed around about that time had a nightmare, because what happened is the mortgages were just withdrawn overnight. So what basically happened is because their mortgages were withdrawn overnight, then they couldn't get a mortgage. So developers had the choice. They either said, you know what, we're going to stick to the contract and we're going to take your money. That's tough on you. But I didn't actually hear of, well, we didn't deal with any that did, but I didn't hear of any that were actually following through on that. Most gave clients another 3 to 4 weeks to complete, and people completed as mortgages started to come back. Now, does it increase during a recession? Not so much so, because the reality is that it's not one of these overnight things. It's not like you bidding on property for whatever, 500,000 and you realize the next day you don't have the money. So not so much so. But what we do notice is during a recession, more people rent. They stop, especially first-time buyers. First-time buyers are the epitome of sitting on your hands and wait for uncertainty to unfold. What they tend to do is they tend to wait. So the completions decrease because there's not as many first-time buyers, and if there's not as many first-time buyers, there's not as many second-time buyers, etc. So during a recession, what we tend to find is more people rent, and therefore again it's putting more pressure on the city centre housing market, and we tend to see that the reality is more and more people, more and more investors get into the market and they buy. I hope it's a bit convoluted, but I hope it makes sense. How is Liverpool performing compared to Manchester for buy-to-let property? In terms of income and in terms of growth, I've answered two separate. They're both great. Look, Manchester and Liverpool are fantastic for buy-to-let property. I would probably say Manchester has the edge for traditional lets, and Liverpool has the edge for your short-term lets. But it's much of a muchness. Wherever you buy, you're probably going to get a great return on your money. It's minor. In terms of growth, they're pretty similar. As I say, the issue that we have seen with Liverpool is a lot of developments that got signed off back 4 or 5 years ago. Some of them are yet to start. Some of them have started and stopped. So that's the issue that Liverpool's had, which is putting a bit more pressure on their rental market. And of course, because of that, the short-term people are going over to long-term lets, which is then putting more pressure on a short-term lets, which means that's why the short-term lets is a bit better, because there's not as many properties in Liverpool on a short-term let as there is in Manchester. Would you go with a studio or larger one bed? Even a 2-bed in the city centre seems like smaller properties yield higher. Yeah, good question. With any of those, you're not going to go too far wrong. We've got a lot of, typically before we would have said 1 to 2 beds, but studios have now come into the mix because people want those smaller apartments. And whereas before you might have, someone who's single get a 1 bed, they're getting a studio, whereas a couple would get a 2 bed to have a spare room, they're now getting a 1 bed. So yeah, I would probably go with studio or 1 beds. 2 beds, again, depends on how many are in the complex as well. If you've got 100 units and 60 are 2 beds, then of course go with a 1 bed. But of course, if you've got 91 beds and only 10 2 beds, then 100% you know that there's going to be a supply and demand issue. So I think it depends on the project, depends on the area as well. Like the exact area depends where in Manchester or where in Liverpool or anywhere, where in London. That question, but any of those, you studio 1 or 2 bed, not a problem at all because they're all yielding similar. St Anne's, what's happening with St Anne's removed from Flambard Williams website? Yep. So look, St Anne's, we're not ducking away from St Anne's. The reason why is we've got a new website launching in 3 weeks, so we're removing stuff. That one website's going down, but St Anne's will be on our new website. It will be the construction updates. We're not selling St Anne's anymore, but of course there'll be any updates with St Anne's going on that new website. But we will have a new website which is launching on, I think, the 13th of March. Might be incorrect on that, but I think it's the 13th of March. What's your view on overseas investments in places like Los Angeles? I don't know, is the honest answer. I haven't got a clue. If you're going from pound to dollars, I'd say anywhere in the US, I wouldn't do it because you're going from pound to dollars. If your money's already in the US, there's probably people far better than me about talking about Los Angeles, if I'm honest with you. I don't know the area well enough to even steer you in the right direction. So yeah, I do apologize, but the only advice I could say on that is going from pound to dollars is probably not the done thing. But I'm sure with any sort of city centre, it's going to be fine. But yeah, I am the least qualified person to talk about Los Angeles. So yeah, I do apologise. All right, someone has just replied. An answer for you. Overpriced market in Los Angeles. Insane there. East Coast is more affordable. There you go. They know better than me. So yeah, well, I hope that helps. And guys, look, have a lovely rest of the month. That seems to have answered all the questions. And as I say, please like or subscribe to this and anything you need. We're going to start to have some great announcements coming on soon. We've got some new launches, which are exciting. We're going to do some live launches on site as well, which is great. We've got a brand new website. We've got our new Prestige arm. So for high net worth clients, we've got our Prestige arm of our business, which is headed up by Shanice Fredericks. She's been with us a number of years now, and that's all we actually launched that with a concierge service. So for those of you that want something a little bit more special, we've got that particular service, and we've got a concierge service with that, which gives you, those tickets to the ticket list events that you can never get tickets for, whether that's the BAFTAs, whether it's the Oscars, whatever it may be. For those restaurants that are always booked up, we can get you into those. That's for our high net worth clients who want something that little bit more exquisite. That's our new Prestige arm. So for those of you that want to know about that, let us know. Brand new website launching. We've got our ambassador. He's a PGA golfer, Wilco Nienaber. He's launching a new competition with us over the next couple of weeks as well. And some new podcasts coming out as well. So loads going on here, guys. I look forward to speaking to you soon, and have a good rest of the week. Take care.